Ajay Srivastava, the CEO of Dimensions Corporate Finance Services, joins us. Good evening, Ajay. Thank you very much for joining us. Well, that's really the first question to you. We are at all-time highs, inching higher with each passing day. Would you think that we can still continue to buy incrementally?
Yeah, I think you have seen, Lata, pockets of outperformance. You saw HDFC Bank, and I think I have a different view on Kotak Bank today. I think the performance was quite mediocre compared to peer group. They had a treasury profit which put them in place, and they had a huge amount of increase in insurance income, which kind of held them steady. But net of that, if you strip the treasury income out of it, really the nuts and bolts of banking has not been that, at least compared to what HDFC Bank notched up. Plus, you've seen the volumes now dropping away. So I think there is now a limit on performance which is now clearly visible, and you can see the stress setting system, including the smaller banks. You saw Lakshmi Vilas yesterday, very mediocre performance coming out of them. So I think, yes, there is euphoria, there is buying in, there is liquidity, but I think now we are seeing the first point of stress in the system is that performance benchmarks are getting hit, and we are seeing the fact that it's not spread over the whole market. Pockets are doing well, pockets are not doing so well. Market is still in a mood to reward even not doing so well, but I think that's going to last only for a while. So you'll see a distinguishing pattern emerging for quite a bit of stocks from this onward to the next rally. And I think that will be the hallmark of this. This is going to be a performance rally. Stagnators will kind of fall aside in the next month or so.
Okay. Well, thanks first for corroborating what was niggling in my mind as well. I mean, HDFC Bank with 5.5 lakh crore assets is growing its loan book at 20%, and Kotak with 1.18 lakh crore is growing at 14-15%. So clearly that distinguishes the men from the boys. But, we also saw cement output increasing. Generally, all the lenders have lent more. Loan growth has picked up, even for Kotak, it's 15% loan growth compared to their own Q3 of about 11%. So is that giving you a sense that, we are on a way to earnings recovery?
I think Lata, I think earning recovery is a relative term to the extent that earning recovery to the past financial or earning recovery to the extent which justifies the valuation. I think if you look at the past, possibly yes, with the passage of time, you will see some performance changing. Cement guys had such a bad year that you can't get worse than what happened last year. So I guess it's important that they come back, and they were under-owned and they were shunned to that extent. So I think you would see a performance change, benchmark changing vis-a-vis the respective. The question is, the kind of valuation we ascribe today, will they meet those norms? Will they meet the expectation? I think that's the crucial test. And Maruti was the crucial test, Lata, today. Sorry, away from cement for a minute. Maruti's performance told us that economy is not giving out the same consumer buying as we all thought it should be. You can see the stress in it. They have cut the advertising costs, which is why the other expenses are lower, but the discounting has gone up, which is why sales expenses have gone up. Yes, they're saying that commodity price has gone up, but really if you look at the financials, what's really happened is discounts are hitting them at the lower end, and that's why Maruti's financials were, I would say, compared to what the market expectation was, definitely subpar. Cement is an under-owned sector. I think many people are not in the stocks, so you'll see a lot of buying. And the stocks are relatively cheap compared to the rest of the market. Look at price to book ratio. The debt to equity is pretty well at this point of time. And there is no new capacity coming up, so competition is not good. So as a sector, it sounds good because consolidation play has removed the weaker players. So perhaps apart from financial performance, the sector itself has become into an attractive opportunity because there are not many players now left and no new capacities coming up.
Ajay, let's stick to interpreting earnings and what signals they give us. And let's talk about the banks, because HDFC Bank came out with this stunning 20% growth. Of course, Lata did speak to the bank's management as well to understand where that sort of a kicker is coming in from. So how have you interpreted some of the financials, whether it was an IndusInd or a Kotak Mahindra Bank today or an HDFC Bank?
See, I think two standout were, I think HDFC Bank was sort of stand out very clearly. You had a Yes Bank, which is again the standout very clearly, and Yes Bank is very, very active in the medium and MSME sectors to that extent. They got a big share. If you look at HDFC Bank, their vendor bill discounting scheme is very popular. The vehicle discounting schemes are very popular. Plus, of course, they have the whole diamond industry with them part of it. That's very popular, and they have the most stockbroking accounts. So I think they each has got niches coming into the play at this point of time, and therefore you see these 2-3 banks giving a lot of volume traction. I think the problem starts with the general players in the market who are trying to do some of retail, some of commercial, some some of large cap names, etc. And that is where the problem is starting, because they are not able to find the right mix of customers to enhance the volumes. So look at vehicle financing. Now, vehicle financing is now getting concentrated with 6 or 7 players in the country. HDFC Bank is huge in that at this point of time. So that's giving them traction. So I think, in terms of performance, you will see very clearly that Yes Bank, HDFC Bank are today at the top of the heap. IndusInd would perhaps follow this. But certainly, and I can see it very clearly, the smaller banks are going to fall off, and it's going to be very, very steep fall off, because they're just not able to compete on cost of funds or the distribution network. So, and that's where the dichotomy will come up, that you'll see smaller banks will become a pure M&A plays rather than fundamental plays.
Okay, that's important because the market has been running them up.